What if a single week could raise the price of your coffee, nudge your mortgage rate, and test the independence of the central bank? This week might be that week. Tariffs are now at modern-era highs across a wide basket of imports. At the same time, the White House nominated economist Stephen Miran to a temporary seat on the Federal Reserve Board through January 31, 2026. One change taxes what we buy. The other could shape how much credit costs. Together they form the core of Trumponomics today. Here is the story of how trade policy and central banking collide, and why it matters for your budget, your business, and your future. The plot begins with a vacancy. A governor leaves the Fed ahead of schedule. The administration moves quickly and taps Stephen Miron for a short term on the board. It is framed as temporary. The deadline is fixed, January 31, 2026. A temporary seat can still matter. The Fed sets interest rates and regulates banks. Each governor is a vote and a voice in the room when the path of policy is debated. If you care about mortgage rates, car loans, or business credit, you care about who sits in those chairs. Miran has argued that the dollar can be too strong for U.S. producers, and that the inflation risk from tariffs may be smaller than headlines suggest. Those ideas fit the administration's trade stance, which raises a question worth pausing on. If tariffs push some prices up and the Fed leans easier to support growth, do we net out fine, or do we import a new kind of risk into the bond market? Keep that in mind, because the next part of the story unfolds in the checkout line. A tariff is a tax on imports. It shows up in the landed cost when goods reach the United States. Importers either absorb it, cut margins elsewhere, or raise list prices. When suppliers are limited and substitutions are hard, prices move. Today, the average tariff burden sits in the high teens, which is historically elevated for the modern era. Models from academic groups and budget labs point to a short-run step-up in the consumer price level. Think roughly 2%. Not inflation every month, but a level shift as the economy resets to the new tax. Translated into a household budget, that step-up can add a couple of $1,000s a year for a typical family that buys a mix of consumer goods with imported content. Apparel basics, toys, some foods, beverage alcohol, and parts used in autos and electronics all carry weight in that basket. So the sticker shocks you see this fall are not a mystery. They are the mechanical pass-through of a policy choice. The mystery is what happens after the first round. That depends on the next character in our story. The bond market. Long-term interest rates include expectations about future short-term rates and a cushion called the term premium. The term premium is the extra yield investors demand to hold a long bond rather than roll over short bills. It rises when investors worry about inflation risk, fiscal risk, or a central bank that might bend under pressure. Now connect the dots. Tariffs can nudge the price level up. If the Fed tries to offset growth risks with faster rate cuts while that pass-through is working, bond investors might add a little extra premium for safety. In plain English, your 30-year mortgage rate can rise even if the Fed trims the short rate a bit, because lenders want compensation for uncertainty. That is why a short-term appointment to the Fed matters. It is not about one person moving a lever on their own. It is about how markets read the institution. If investors believe the Fed will keep inflation anchored while managing growth, risk premia stay contained. If they doubt that, those premia widen, and financing costs creep up across the economy. So we return to our opening question. Do tariffs plus easier policy net out fine, or do they invite a new cost into the system? Before we answer, meet 3 people living this story in real time. A logistics manager checks a container of toys. The landed cost is higher because of the tariff. The importer edges up list prices and trims promotions. For 2 weeks, shoppers do not notice. Then a favorite item that was $24.99 is now 27.49. The receipt tells the story. A small manufacturer picks up new orders as a client diversifies away from imported parts. 2 operators are hired. Steel inputs cost more and deliveries take longer. Margins hold for now. Investment plans depend on whether the orders are a blip or a trend. The owner asks one question at night. Do I buy a new mill this quarter, or wait until rates feel predictable? Traders mark in a few basis points of extra term premium. Not panic, just a little insurance against policy uncertainty. They read the Miran appointment as a signal that the White House wants faster easing while tariffs bite. The exact outcome depends on the data and on who follows Chair Powell. For now, they hedge. 3 rooms, 3 choices. Raise a price, delay a purchase, add a hedge. Each choice is rational on its own. Together they form the economy we all live in. Here is a common confusion. A tariff shock can look like inflation when you feel it at the register. In macro terms, it is a price level step-up. That means the price of a basket of goods jumps to a new level as costs reset. It does not mean the basket keeps accelerating month after month. Persistent inflation comes from second-round effects that keep feeding on themselves. For example, if firms keep raising prices to protect margins, and wages chase those prices, and expectations start drifting, you can get a more durable problem. The Fed's job is to break that loop. Which brings us back to institutional trust. If households and markets believe the Fed will hold its mandate, the one-time tariff bump stays a bump. If trust is questioned, the same shock can echo longer than it should. So what happens next? That depends on 2 hinges. Trading partners can respond. If they target U.S. exports, the growth cost rises. If Washington grants wide exclusions or phased implementation, some pressure eases. The map of winners and losers shifts with each carve-out. A credible central bank can look through a one-off price shock while keeping expectations anchored. A politicized bank cannot. Investors know the difference. So do households when they set wages and prices. This is why a temporary seat on the Fed is not a footnote. It is a signal about the path the administration prefers while it searches for a permanent chair. Markets listen for signals, then price them. And there is a practical timeline the public will feel. Grocery items with limited domestic supply shift first. Apparel passes through within a few shipment cycles. Autos and electronics take longer because dealers work down inventory. By the time the average viewer notices the last category, the first wave is already in the rearview mirror, which sets up our next small cliffhanger. If prices settle, do rates finally fall and stay low? Short-term rates answer to the federal, long-term rates answer to the Fed plus the market's nerves. If policy leans easier while fiscal deficits remain large and tariffs hold prices up for a time, long bonds may not follow short rates down quickly. That tug-of-war is the yield curve you hear about on the news. For a homeowner, that can mean cheaper credit card rates and auto loans before you see a meaningful drop in 30-year mortgage rates. For a small business, it can mean a better line of credit while equipment financing stays stubborn. None of this is dramatic on any single day. It is steady pressure that changes decisions at the margin. Remember our 3 rooms. The importer adjusts prices. The machinist times a purchase. The trader adds a hedge. Multiply those choices across millions of actors, and you get the macro picture. Watch retail categories where substitution is hard. Coffee, basic apparel, toys, some wines and spirits. Expect staggered pass-through as tariff-free inventory runs out. Watch bond market measures of inflation compensation and term premium. If they stay contained, it signals trust. If they jump, financing costs will feel heavier. Watch the Fed's language around transitory versus persistent. The words matter because they tell firms how to price and workers how to bargain. Also watch for exemptions and diplomatic signals. A few well-placed carve-outs can cool pressure without rewriting the broader policy. For a family on a tight budget, a couple of $1,000s across a year is not an abstraction. It is groceries, shoes for the kids, or a few months of savings that never happen. For a small manufacturer, a quarter-point change in borrowing costs can decide whether to add a shift or wait. For a recent graduate, a labor market that slows 0.2 of a point changes how long the first job search takes. These are not markets in a vacuum. They are people making plans under uncertainty. Policy either lowers that uncertainty or adds to it. This week's chapter of Trumponomics is a collision of two levers. A tariff wall that raises the price level in the short run. A shift at the central bank that could influence how credit is priced while that shock moves through the economy. The clear takeaway is simple. A one-time tariff bump does not have to become a lasting inflation problem if the Fed keeps expectations anchored. But if the institution looks politicized, the bond market will charge a premium that households and businesses eventually pay. So here is the question to carry with you. What is the real cost of influence over a central bank? Is it cheaper prices today or higher borrowing costs tomorrow? You have been watching Econolocast. If this helped you make sense of the week, share it with someone who needs a clear view of the stakes. I will see you in the next episode.